What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is March 31st of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got a jam-packed episode to close off the month with, as we're going to not only be diving in to our price analysis for both Bitcoin and total crypto market cap, but on top of that, we're going to be diving into the euphoria and equity markets, talk about whether or not we think this is really going to be the start of a new bull market, and outside of that as well, diving into what's going on in commodity markets, Forex markets, and talk about the unavoidable topic of inflation, as the PCE report is going to be dropped later today. And above all, I'm going to be sharing with you guys a brief overview of my strategy going into Q2 of 2023. We've got a jam-packed episode to dive into today, guys, so if you enjoy the rambling, consider dropping a like. It's one of the best ways you can support the channel, and let's go ahead and kick off the conversation. All right, so I want to go ahead and start by talking about Bitcoin's price here. As we can see over the past couple of weeks since we entered into the later half of March, Bitcoin has been trying to turn this previous upward band on the expanding channel for Bitcoin's price since back in January into a new line of support. And while we have been able to hold above here so far for the most part, this very much looks to me like it could be distribution. So I want you guys to heed caution. I know there's a lot of FOMO, a lot of excitement to potentially not miss out on the next bull market, and we'll talk about that as we go throughout the video, right? But the big thing here I want you guys to know is that, again, so far, technicals are still looking good here. We're still holding up on the top of this band, but I want to go ahead and talk about something more important here. And this is where, again, you can start to find some really good levels to watch for in future trade setups for swing trades to the upside or the downside. And that is the Lux Algo indicator known as price action concepts. So this is one of the three main indicators that you get, the premium indicators you get when you subscribe to Lux Algo. And for me, this is one of the favorite tools of mine that I like to look for when I'm looking to potentially, in a bear market, short relief rallies or start to take more bearish positions, and vice versa during bull markets to find ranges where there are demand, where essentially there could be buyers coming in to provide support. And one of those ranges we've got to talk about is the level that was set back here in late May of 2022. Almost a year out ago, we set in this level here in the price action concepts, and this was a significant range of volume here, with yet again, as we saw through most of these levels in the price action concepts, seeing an outweigh of sell side volume each and every time. And I'm thinking that even if we have a continuation over the next couple of days towards this range around 30K, this is as far as it's likely going to go. I know a lot of people are convinced of the kind of bull market argument that we're in the next bull market, that it's time to get euphoric. But folks, the big thing I want to ask here is really long term, what is the narrative that's going to drive this bull market? Is there some new catalyst in crypto like there was last time, such as DeFi, that really played a big role in the altcoin space and continue to drive up euphoria for the broader Bitcoin price? Is there going to be some other type of narrative that's going to take Bitcoin sky high? The only narrative I've really heard so far that gets people really excited is supposedly this idea that there's a massive bank run and that everyone is rushing into taking their current deposits and buying up Bitcoin, and that we're going to go to $1 million. And to be honest with you guys, trust me, I am, as much as the next guy, excited about Bitcoin being this alternative hedge. But if you're taking a look at the market order flow, if you're taking a look at stablecoin liquidity, some of the metrics that we have to really gauge whether or not liquidity is flowing into the space, we're not seeing some massive inflow. We're seeing very little spot volume for the most part, typical with what we've seen over the past year or so during this bear market. But on top of that, we have thin order books, which lead to dramatic swings in price, and we see a lot of people taking advantage of this opportunity in price moving higher. Look no further than the overall multi-book tool through Bookmap, one of our partners here on the channel. Again, we can see continuous negative cumulative volume delta here. Still throughout the later part of the week here, we had some optimistic flows here coming in back a couple days ago, back on the 29th of March, but that has flowed out as every time we get up into this upper band, people are taking advantage of that price swing. people are essentially distributing. They're starting to sell large positions. And there are a lot of potential players that could be taking advantage of the sell side pressure. We don't need to know exactly who they are. We know it could be holders at Mt. Gox. We know it could be other types of players going through debt restructuring in the crypto space. Could be crypto miners who are overexposed and need to cover their hardware costs. It could be a whole range of different players. We don't know their names, exactly who they are, but we do know that there is more sell side pressure across the major exchanges on the spot market than buyers. And that is why you're starting to see over the past 2 weeks a bit of resistance at this range. Could this be where price starts to top out? I don't know if it's going to be exactly here at 27 or 30K, but I got to tell you guys, the momentum is starting to slow here. And it's looking a little bit overbought here considering the macro conditions that we're in, which for me makes it an opportune range to start looking at potentially shorting some of the plays like MicroStrategy and Coinbase on the equity markets that I have access to, being from the US. I haven't made any trades yet. I'm not saying to go all in. We recommend, in this case, remaining mainly in cash. And that's what we've been doing for the past couple months. But generally speaking, that's the kind of plays I'd be watching for. But again, if you guys are interested into getting access to some of these tools, whether it be Lux Algo or Bookmap to be able to track market order flow or the price action concepts indicator, as well as some of their other trading indicators, you guys can get a discount code down below in the description, 30% off using the code DD30, which is going to allow you to get a discount and be able to access some of these really exciting indicators. And for Bookmap, you guys can get 20% off using the code down below for your first month. These are tools I recommend you guys use if you are trading large sums in the market. I recommend utilizing them in order to try to gauge better swing trade opportunities. If you can make in a given year 3 to 4 good trades, roughly speaking, and you have the right indicators that can help you give better confidence in your trade setups and make sure that you don't trip up on simple price action, that's what's going to help you win in the market long term. Plain and simple. These are really the only indicators outside of one of our other exclusive indicators we talk about within the Dash report, which is one of the ones that I like to use for momentum shifts. And of course, the moving averages. These are always a consistent, time-tested indicator between the 200-day moving averages and the 200-week moving averages. And speaking of that, I want to go ahead and talk about the euphoria going on in the stock market, because we have had a lot of optimism in tech plays since back in October. And this has left a lot of people who, again, are in cash right now wondering whether or not it's time to go all in. Is it time to prepare for another bull market and to get euphoric? And again, I come back to this point here, right? While the world may be not all doom and gloom, and yes, maybe the Federal Reserve might have averted a crisis with the recent bank runs we saw in Silicon Valley and First Republic Bank coming into the rescue and providing ample loans and liquidity to these banks through an emergency lending window. The question here we need to ask is, what is going to drive this bull market long term, right? If that's the narrative that people are going on, that we're in a bull market, what's the bullish narrative that's really going to drive it higher? Now, I know there is one right now that's gotten a lot of people excited, and it's why I've got Microsoft pulled up here, and that is companies like OpenAI that are leading the way forward in AI innovation. Not to mention the GPU manufacturers that are powering a lot of this trend, which is NVIDIA. NVIDIA, since back in October, since we really set in those lows in tech stocks, has gone from around $107, $108 per share, all the way up to $273. Not bad if you can get it. And while I want to make something very clear here off the bat, which is that, folks, if you're feeling like you missed out on something here, there's always going to be anomalies in the stock market. You could always say, oh man, I wish I would have bought that when I started using ChatGPT. Oh, I should have bought that. Don't beat yourself up, guys, on these kind of things, right? It's not about how much you can make in opportunities. It's about how much you can afford to lose in a potential trade. What's your risk reward setup? And if you miss a trade, it's okay. There's going to be thousands of opportunities out there, some of which are much easier to predict and will pay even bigger returns than some of these trades have. But that being said, I want to go ahead and emphasize a really important point here, which is if we take a look at the long-term outlook of these companies, we need to ask whether or not these few narratives or trends that have got the market excited in the short term can really sustain a long-term bull market. Now, I like the topic of AI. It's gotten me much more interested since ChatGPT. And I've definitely utilized these tools in exciting ways. But I have to tell you guys, as much as these tools are going to be very useful, they are not going to be profit generating for a long period of time. And going into a recessionary environment, you can see that NVIDIA, whether you take a look at NVIDIA's inventories, they are not meeting up to the same demand they had a year or two ago, yet it's trading at a price to sales ratio or PE multiple much higher than where it was at the peak of the bull market, 155 on the price to earnings ratio. Think about that for a minute, right? NVIDIA is not the same kind of high growth stock it was over the last decade. It's going to probably continue to grow. I'm not going to sit here and say that it's not going to be able to hold up where it was over the past couple of years. It might be one of the few anomalies due to the advancements in AI, but is it going to be enough to really clear through the absolutely massive inventories that NVIDIA has? Same with Microsoft. Microsoft's business overall, the vast majority of it is software. It's offering different types of services that it's offered for the last couple of years, some hardware devices as well. And the question is whether or not OpenAI and its stake in OpenAI is going to be enough to really drive Microsoft towards increasing its valuation by billions and billions of dollars. I want to go ahead and just kind of bring this into perspective here, right? OpenAI as a company makes up a fraction, anywhere from 1 to 2.5% of Microsoft's valuation, right? And its own stake in OpenAI. And as we talked about in one of the prior videos, OpenAI is only planning to be able to potentially make $1 billion in revenue by the end of 2023 or 2024. $1 billion in revenue. Bear that in mind. Now it's burning through capital every single day. That's for sure. It's not a cash cow. It's more of a cash burner, so to speak. And on top of that, projections are that we're going to reach $1 billion in revenue, not profit, revenue, by 2023 to 2024. Doesn't sound very optimistic to me. Now, that's definitely great, right? But if that's their expectations for a year and a half out, it's not enough to justify Microsoft's $2.1 trillion valuation going into a bear market or a recession, right? An earnings recession, where a lot of the demand for cloud-based services like Azure, other software within the Microsoft suite, that's not going to be able to save Microsoft. And if this giant can't continue to maintain higher lows and higher highs and maintain above this 200-day moving average in the 200-week, that's not much of a justification to lead a bull market. And as I've pointed out before, many of you already likely know this, previous market leaders like Microsoft and Apple and Amazon and Netflix and Google tend not to be new market leaders in a new bull market. The market looks for new leadership time and time again in the vast majority of cases. This would definitely be a pretty large anomaly. Not saying that it's not possible, but I definitely am not betting my cards on it. Now, it's not just these tech stocks that are holding up. You've also got the FANG stocks, which are back up towards their relative February highs, somewhat to a price range we saw back in September of 2022. And while we are still below the 200-week moving average, a lot of people, again, are starting to feel the FOMO with this pattern of higher lows and higher highs. And we're also seeing that similarly in the broader NASDAQ, as we're again back up here in this range in February. Now, we've talked for some time, we talked about even back here in February, although we didn't get it at this time around. We've been talking about testing up towards this 12,600 point range on the NASDAQ, which is another 3 or 4% move from here. And I have no doubt that it could possibly play out that way. But I want to come back to the center here, guys, because I know a lot of people are thinking, oh man, I wish I would have caught this rally. But if you guys are like me, I'm not always trying to trade every rally. Sometimes I'll trade rallies and also sell-offs as well when I know that I have a good setup, when I'm feeling the trade is good, when I have the confidence to be able to make those positions. But in the longer term things, I'm focusing on whether or not we are at a capitulative low and ready to start the next bull market. That's what I care about. When is it time to really start dollar cost averaging? When is it time to go heavy and maybe even start packing in a couple of leverage positions with ample liquidity to back them up in order to start building those positions during capitulative events? To take risk when no one else is willing to, not when everyone wants to. That's the worst time to take risk. When you're feeling that itch, that FOMO to get into the market, when you're hoping that the Fed's going to come in and provide that ample liquidity, right? It's the worst time to go in when you're going off of false hopes that the Fed will be able to just print massive amounts of money. And unfortunately, I know that a lot of people have gotten excited about the QE going on, but it's not enough to stimulate another bull market. And with the Fed continuing to raise interest rates over the past month, it is a sign the Fed is going to continue doing its job. It's doing the bare minimum. We'll talk about that a little bit later on. But I want to go ahead and dive into some really interesting macro things. Again, just to summarize here for Bitcoin, for crypto, for the total market cap here as well, we can see coming back here to Lux Algo, we're entering in to that potential resistance band here, which again has not been surpassed since back in January. That's going to be a real test here for the market. And we think we're going to come down and really get that typical 85% correction coming down into this band here, where we saw price face resistance back multiple times in the past. That would be an ideal range of support for total market cap, flushing a lot of the noise in the altcoin space, looking for new market leaders and new trends. That's the long-term game, guys. We have to be patient here and know that this is going to be a first-time environment for so many things here, for crypto and for a lot of new industries and sectors. Speaking of which, of talking about things that have happened really for the first time, China has made some pretty big waves here in an exchange with Saudi Arabia in exchanging liquid natural gas, or LNG, for Chinese yuan. This is starting to, again, be one of the early stage signs of a multi-decade trend where the dollar is potentially losing its place as the world reserve currency. Now, I wanted to go ahead and talk about this news piece because a lot of people usually get very fearful when they see this. They think, oh my God, this is being, the dollar hegemony is over, the petrodollar is over, and that the dollar is just going to collapse tomorrow. When in reality, guys, at the end of the day, this is just about 2.7% of the market is traded in Chinese yuan versus the US dollar share of 41%. So going into a fearful environment, I would not be betting so much against the dollar, with the Fed continuing to likely signal raising interest rates over the next couple of months and next couple of quarters, at least keeping them suspended and keeping a relatively strong dollar. I wouldn't be so much concerned by news like this. And to be honest, these are interesting macro times where essentially China has to basically utilize the Chinese yuan, especially other countries as well, like Russia, are going to have to do business in Chinese yuan. This is typical with the macro environment we're in right now. But again, at the end of the day, this is definitely a longer term trend where the dollar could be put into question of its leadership position. I don't think the yuan is going to be that currency, but at the end of the day, the key thing here is to understand that this is a long-term trend here, where eventually we might look for new leadership, and who knows? If Bitcoin continues to grow in adoption, institutional embedment within the system, perhaps Bitcoin does become that currency. But it's not something that's going to happen in 90 days, like people like Balaji are saying. I hate how so many people are convinced of this narrative, because it's going to lead so many traders, so many people taking excessive risk, unfortunately getting sidelined, taking on leverage positions, all the kind of damaging stuff that we try to warn people against here in this channel. It's not about going long. If you just want to buy Bitcoin as a long-term position, that's fine. But going out there trading on leverage, trying to revenge trade, make up for previous losses, thinking that it's going to be exactly like it was over the last decade, guys, really you got to play it safe. I'm only saying that here. I don't have my referral link to show you guys to go make every single trade in the market. I want you guys to make as few trades as possible, well-coordinated trades, ones that are going to help protect and preserve your capital and hopefully be able to make some good returns in the long run. Now, I want to go ahead again, talk about how this ties in. This is likely going to be an important index to watch, which is the dollar index. While I understand a lot of people are looking at news like this and getting really worried about the dollar, what I'm looking at here is generally seeing how we're getting dollar demand here on our previous range of support back in the past, around this 101, 102 range here on the Dixie, potentially setting in a double bottom higher low. So I would definitely keep an eye here, because if the dollar starts to charter higher, we've seen a pretty direct inverse correlation, where when the dollar is shooting higher, we start to see the market is pricing in through Forex markets, a very effective market alongside bond markets, is pricing in that the Fed is going to continue outpacing other central banks, continue aggressively tightening, and that is not going to be a good look for equities, dragging the high risk plays down with it. And on top of that as well, we got to talk about another macro sentiment indicator here when it comes to the petroleum markets, which is that essentially with a higher price in oil, there's likely to be a higher dollar. This plays back into this topic around the Dixie. Essentially speaking, with this article here, this is focusing on Secretary Jennifer Granholm, who's essentially at the helm of leading the direction around the SPR, Strategic Petroleum Reserve. This is how we were able to suppress the price of oil. Oil probably would have gone much higher over the past year or so and probably stayed in triple-digit territory per barrel. However, the United States had a large strategic reserve of petroleum, which they utilized to unload onto the open market to counteract the imbalance between supply and demand. Now, while the administration was currently looking to potentially add back at around $67 to $72 per barrel, there is starting to be some signs as to whether or not they're going to be able to do this and how quick they're going to be able to add back to that strategic petroleum reserve. And if we take a look at the price of oil, right as it entered into that price band, we saw a massive move higher here following the recent sell-off around 13% back in the midweek of March. So unfortunately, that demand zone where the federal government is looking to step in and add in reserves to quite a large extent is looking like it's quite short-lived. So the U.S. is in a bit of catch-22. While it used the Strategic Petroleum Reserve to keep oil down, it's not going to be able to add it back so aggressively because it's just going to ramp up prices here. So this is, again, a really important thing to understand here when we talk about the important dynamic which cannot be ignored, which is inflation. And we got to close off on this topic, guys, because this is a big piece of what you need to be prepared for when it comes to your strategy. You know, when we talked earlier about all those bullish narratives that people are excited about, the kind of straws that people are holding on to say, oh, this is why markets are going to go set a new all-time highs. This is why we can take excessive risk. This is why we should go buy GameStop stock, and we should go buy, Nvidia and all these companies. And it's just going to be great. It's going to be like it was back in 2020 and 2021. The problem here is that while some of those narratives might be interesting, none of them are as strong or as relevant as the weight of inflation and the dynamic that inflation is sticky and that it can remain for a long period of time like it did in the 70s unless it is dealt with properly. For example, we not only have these fears around oil, we've also got concerns around the supply of copper, looking like we may have a long-term copper shortage supply due to the advancements in not only semiconductors, but also as well in electric vehicles and the grid transformation, all of the forms of renewables that are driving demand in copper and all types of different industries. And this is going to likely continue over the next couple of years. We can see it playing out in copper's price. We saw it very clearly here as copper went through its first initial sell-off during the tightening period back in the summer of 2022 when interest rates started to move higher, and notice how it found multi-month support within the 200-week moving averages. It's gotten above, turned that 200-day into clear support, and is now looking like it's ready to charter higher. This is one of the big dynamics that people need to focus on. And I think one thing that really serves as a really good kind of point to illustrate this is the moves that Warren Buffett took on Occidental Petroleum. Now, Occidental is a pretty large oil producer in the United States. They are a $50 billion company at current market capitalization. Berkshire Hathaway owns about a 23% or 26% stake in the company, so about $10 billion. I want to ask you all this here real quick because, as you can likely see here, it's all public knowledge. Warren Buffett is likely planning a quote-unquote kind of hostile takeover, or what Berkshire usually does. They acquire good cash-rich companies that they hope will, bring return on their initial investment and allow them to continue expanding their moat and continue making more money. Why do you think Warren Buffett would be buying such a large stake and making such a large oil bet with his available cash if he didn't believe that over the next 10 years he was going to make his money back? I want to talk about that here, right? I'm not even the biggest fan of Warren Buffett. Right? Warren Buffett's got his points he can be critical about. But at the end of the day, Warren Buffett knows how to play his game. And I don't think Warren Buffett would be buying such a large stake in a large oil producer if he didn't think that there was a chance that oil prices stay suspended. And if oil prices are staying suspended, that's going to lead towards inflationary pressures. And if inflationary pressures are increasing, that means it's going to have a contagion effect on other different types of commodities and goods and services in the economy. And it's going to likely leave us in a stickier situation of inflation. We have already started to see this play out here with, back in February, having a reading of over 0.6% month-over-month expansion in the core PCE. Now, I understand a lot of people believe that inflation is done with, that there's a lagging effect with the monetary policy tightening, and now that the Fed has to step in, inflation is secondary now. We have to save the financial system. That means we can go speculate on Nvidia stock, Microsoft stock, and times are just going to be good again, right? But folks, really just take a step back here. If you're still here with me right now, if you guys have been able to tolerate my rambling, really think about it here for a minute. Does that really make sense that the Fed can just ignore inflation and let it get out of hand? and potentially get to a point where, the Fed really starts printing like they did before. I mean, we've already got a lot of excess liquidity, and we had a decade or more of low interest rates. If we're just going to pivot back, right, and start printing and lowering interest rates, if we've got 0.6% month-over-month inflation last month, what's it going to be when we start printing a ton of money and lowering interest rates again? 0.8% month-over-month? 1% month-over-month? You're talking about an annualized inflation rate potentially up to 10 to 12%. And that's just going to be the new norm? I don't think so, guys. I really, at the end of the day, as I've said before here in the channel, I just want to reiterate it. I'm not absolutely short the market or short Bitcoin yet. I'll let you guys know generally when we're looking at potentially building positions, right? And on top of that, I'm just trying to be realistic with you guys, because while I don't have a monetary incentive to be bearish, at the end of the day, the fact of the matter is it's the macro environment. And I'm not going to sit here and lie to you guys and try to give you false hopes. We have the new PCE numbers coming out here later on this morning on Eastern Standard Time. A little bit after this video will be up. And it's expected to be 0.4% month over month. That alone is already bad enough. But if we get another 0.6 month, or we get another reading above that metric, it is going to prove yet again that the Fed has not done their job yet. And the Fed is going to have one of two choices. Either they're going to step in and do the right thing, or they're going to kick the can down the road. Maybe the stock market and crypto rally for a little bit longer, but eventually a rude awakening is going to come. And we write about that in this month's Dash Report. This is our newsletter here on the channel, where you guys can not only get access to my trade alerts, mid-month webinars, and exclusive market updates outside of the ones we do here on the channel, but so much more. And specifically, each month we drop a 20-page plus newsletter where we talk about everything going on in crypto markets, equities, commodities, and Forex. We do a whole 360 view on what's going on in crypto markets. And on top of all of that, you get to engage in conversation with the Dash Report discussion group. This is a membership group of hundreds of members, of some of the best quality members within the DataDash community, sharing trade setups, talking about what they're seeing in the market, and just generally getting a discussion going and asking questions. This is one of the biggest value adds I think you guys could get here when it comes to trading. And you guys can get a 20% discount when you sign up for the newsletter at the link down below for an annualized basis. But this is one of the great ways you guys can support the channel and also get an edge in the market and really see when I'm making trade positions from the indicators that we utilize when we feel there are good trade setups and opportunities, and just generally what our macro thesis is on the overall market. There are a lot of moving pieces. It's hard to keep up with it all sometimes, and that's why I try to focus full time on doing that for you guys and letting you know about what opportunities I see and when I try to ignore the noise, the FUD, the FOMO, and really focus in on real trade setups. If we can get a few good trades right each and every year, we can come out making some really great returns, outpacing the market, and yes, hedging against inflation. I know that's what's on everyone's mind right now, but generally, you have to be well coordinated in these kind of uncertain flat or bear market trends. We can't be too optimistic on every euphoric rally, and more specifically, learn to take advantage of relief rallies during a broader term downtrend, as vice versa, during bull markets, during secular bull runs over a 5-10 year period, we buy the dip every time because we know the Fed or other reasons are going to drive prices higher in a longer term uptrend until something switches, like it did back in November of 2021. So, anyways, guys, that's it for today's video. I rambled on again about. If you guys enjoyed my rambling, though, consider dropping a like. It's a great way to support the channel. If you guys can't check out the other things that we utilize here on the channel, dropping a like is one of the best ways you can support the content here on the channel. Spread the word to friends and family members. We need to get this kind of rational thinking out to more people. But until the next one, I'll see you all in the next video. Take care, everyone.